Hi all, good evening and welcome. I am Ridhil Mishra from the Corporate Communication team, and on behalf of CareEdge, welcome you to our today's discussion on positive credit outlook, sustainable or shaky. We sincerely appreciate your time in joining us for this webinar. We would like to welcome our esteemed guest panel speakers for today. We have with us Mr. Jugeshinder Robbie Singh, Group CFO, Adani, Mr. Jairam Sridharan, Managing Director, Piramal Capital and Housing Finance Limited, and Mr. S. Anantharaman, Chief Risk Officer, Bank of Baroda. The session will be moderated by Mr. Sachin Gupta, Chief Rating Officer at CareEdge. We will commence the session with a presentation by Revati Kasture, Senior Director at CareEdge. This will be followed by a panel discussion, and we'll be having a Q&A session at the end of the discussion. May I invite Revati to begin the presentation, please? In a current role at CareEdge, Revati heads the criteria and quality control team and is responsible for strengthening methodologies as well as processes. Over to you, ma'am.
Thank you, Mridul. I will now take you all through a short presentation on a half-yearly credit assessment report. This half year, we clocked our decadal high credit ratio at 2.64 times. To define credit ratio, it's a ratio of upgrades to downgrades. And this half year, we had 2.64 times upgrades to downgrades. An increase in the ratio as compared to the previous period denotes an improvement in the credit quality of rated entities and vice versa. So in the H2 FY22, CareEdge ratings upgraded ratings for 468 entities and downgraded 177 entities. The uptrend was contributed by upgrades in infrastructure and manufacturing services sectors. We will delve more on which industries in these sectors contributed to the higher ratio later in the presentation. The upgrades can be attributed to a higher demand with the economy opening up, releasing of pent-up demand, lower tax regimes, lower cost of capital, better realizations, improvement in profitability, as well as significant deleveraging by India and corporation. This was hugely supported by government spending on infrastructure and schemes like Atmanirbhar Bharat, PLIs, etc., production link incentives, etc. Go to the next one. If you look at the high frequency indicators which are there in front of your slide, then these indicators have shown recovery as denoted by both IIP as well as GST collections. The industrial growth has peaked in H1 FY22, aided by a negative base and momentum in vaccinations and return to normalcy. The half-yearly GST collection of 8.1 lakh crore in H2 FY22 has been the highest ever as depicted by the bar graph on the right side of the slide. Bank credit growth has also shown improvement and we expect that to sustain in the coming year too. The next few slides will give you a bird's eye view of CareEdge ratings portfolio. All the charts and numbers that are presented are only for active or live ratings and do not include issuer not cooperating ratings or INC ratings. If you look at this slide, the proportion of investment grade ratings in our portfolio has increased from 44% to 67% from 2018 to 2022. Does this mean that the credit quality of the portfolio and therefore of the corporates has increased substantially with rating movements from below investment grade to investment grade? Well, not really, because in the last 2 years, a large proportion of the lower rated entities predominantly belonging to the below investment grade category have turned issuer not cooperating. And as I have mentioned earlier, the data that we are presenting in all these slides is only for the live ratings. So the investment grade ratings is BBB minus, A3 or higher, and below investment grade is BB plus or A4 or lower. If you look at the median rating across the rating portfolio, because of the increase in the investment grade ratings, this has also moved from BB in FY20 to BBB in FY21 and continues to be in BBB in FY22 also. The slides ahead will give you a glimpse of the movement of this credit ratio, which is the ratio of upgrades to downgrades in the past decade, and the sectors and the industries which have contributed to the same. With the onslaught of the pandemic, this ratio really dropped to 0.49 in H1 FY21, as can be seen on your slide. And thereafter, there has been a steady but steep recovery in this ratio to reach 2.64 in H2 FY22. If we split the ratio further into what does this ratio look like for investment grade entities, which is BBB minus and above, and for below investment grade entities, then we find that the credit ratio, while for both investment grade as well as sub investment grade or below investment, has moved up. The ratio is higher for investment grade entities, which means a larger proportion of IG investment grade entities have been upgraded. If I try to map this credit ratio with the GDP growth, then we see almost a mirroring of this. And obviously, we can say that the direction of the credit ratio is a good indicator of the GDP growth in the country. Now, what has led to this momentum in the credit ratio? Is it that we had significantly higher upgrades? Rather, we had significantly lower downgrades, because this half year we had the lowest percentage of downgrades at 7% in the past decade. In all other years, we had a significant higher proportion of downgrades, also in comparison with the upgrades. We will now focus on sector trends and credit ratios across BFSI, infra, and manufacturing and services sectors. If you look at the sector ratios, then infra segment has registered a superior credit ratio at 3.17 times, followed by manufacturing and services sector. For the first time since the NBFC crisis, the BFSI credit ratio jumped to above unity at 1.24 times. Let's look at the sector cuts now, the banking and financial services. As can be seen in the bar chart, the proportion of upgrades to reviews has risen from 4% in H2 FY21 to 8% in H2 FY22, which is essentially because of the easing of asset quality concerns post-COVID, regular capital infusion, debt plus equity, leading to stable capital adequacy ratios, upgrades in the securitization transactions driven by improved performance, with collections reaching almost pre-COVID levels and rundowns of pools, and banks overcoming the asset quality review hump in provisioning and ends exhibiting higher profitability. So the BFSI ratio was higher than unity this time. If you look at infrastructure, which has clocked the highest ratio, this was essentially driven by the power sector, with accounting for about 49% of the total infra upgrades. Accounting for about 49% of the total infra upgrades. If you look at the bar chart, it depicts that as a percentage of reviews, the solar power really leads the pack, with 40% of the entities reviewed being upgraded, followed by the toll roads sector. Within the power sector, as I mentioned, the solar sector was the one which was seen the most upgrades, and all this is because of robust generation track record and conducive regulatory environment, operationalization of projects, and capital infusion by strong investors. On the road sector, 24% of the entities reviewed in roads were upgraded, triggered by hybrid annuity model projects achieving commercial operation date, significant reduction in finance costs with refinancing, demonstrated track record of toll collections for mature toll roads despite the pandemic, and strong sponsors, private equity players taking a stake and infusing equity in the projects. Now we look at how the manufacturing sector or the services sector has seen an uptick. The credit ratio for manufacturing services sector is again the highest in the last 10 half years. The sectors which contributed are mentioned in the bar chart on the slide. About 29% of the companies reviewed in iron and steel were upgraded, followed by 25% in chemicals and 23% in gems and jewelry. With respect to the iron and steel sector, the upgrades were essentially triggered by recovery in volumes and strong uptrend in prices, substantial deleveraging and expectations of a comfortable financial profile in the medium term, fewer capacities coming on stream in near term and limited imports, and expectations of a healthy profit margin of steel players, although they shall get adversely affected due to input cost pressures. Upgrades in the chemical sector were essentially due to supply chain disruption in China and China plus one strategy of vendors, improved realization with high demand from domestic end user segments. And of course, due to cost plus pricing model of Indian players to protect against sharp increase in raw material prices. If we look at the gems and jewelry sector, then about 23% of the ratings reviewed in the gems and jewelry sector were upgraded, and with a very low proportion of downgrades at only 2% as compared to the previous half year. With faster than expected recovery in demand from key consuming nations and overall exports of the cut and polished diamonds having crossed pre-COVID levels. Also in case of gold, it was largely pent-up demand and demand surpassing pre-COVID levels to achieve a 6-year high in demand for gold jewelry. Real estate, if you see on the right-hand side, the bar chart depicts was a mixed bag with 22% of the ratings being upgraded and 11% being downgraded. The upgrades were essentially because of pickup in sales momentum, collections, reduced unsold inventory, and regularization of debt servicing, whereas the downgrades were because of lower occupancy in commercial real estate for LRD transactions and for smaller developers, non-realization of committed receivables on sold inventory. The pharmaceutical industry was largely resilient and it benefited from the pandemic with increased scale of operations, profitability, revenue visibility, and significant deleveraging, increase in government spending with Ayushman Bharat and support by way of PLI, and diversification of sourcing base by global pharma companies. The upgrades in auto were driven mainly by ancillaries and dealerships because of surge in demand, including pent-up demand due to post-pandemic and new vehicle launches. The demand is expected to remain robust with a low base effect, improving demographics, and continued focus on personal mobility. Rising fuel commodity prices and resurfacing of the semiconductor shortage are, of course, key monitorables. The worst hit sector amongst all the sectors was the hospitality sector, and it continues to bleed with a large number of companies getting downgraded. Slower than expected recovery is evident in most segments post the pandemic. Business travel is yet to pick up, and with changing work patterns and virtual meetings, the need for travel has also taken a hit. The demand pickup in Q3 FY22 was tempered by a fresh wave of Omicron, which saw booking cancellations, lower occupancy, and lower RevPAR. So, all in all, while the Indian economy seems to have weathered the pandemic and the leverage indicators are at comfortable levels, pointing out to a positive credit outlook, do we expect some speed breakers considering the geopolitical situation and rising COVID infections in some parts of the world? While the pandemic is decisively behind us, are we entering a phase of sustained positive credit outlook or with confidence, or is the outlook shaky? Some of the roadblocks that come to our mind are increasing crude prices, impact on India of the same, rising commodity prices, which might impact profitability of players, inflation and expected rise in domestic interest rates, which might affect margins and viability of projects. CareEdge expects a 75 basis rise in policy rates in FY23. With the Fed tightening with an estimated increase in rates to 1.9% in 2022, it's also likely to have an impact on India. So how well is India poised to overcome these roadblocks? Can they threaten the positive credit outlook? What are the challenges that the industry is likely to face? To answer these questions, we have eminent people on our panel with us today. I would first like to introduce the Chief Rating Officer of CareEdge, Mr. Sachin Gupta, and would request him to introduce the panelists and initiate the discussion. So,
thank you, Revati.
Sachin Gupta, yeah.
Okay.
Go ahead.
So, yeah. So, thanks a lot for this presentation. I think it basically Revati's presentation spoke about how things have been good in the last 6 months, and that is the reason why the ratings have been moving up. Where she's left the presentation is that while last 6 months have been great, but going forward in future it doesn't really look that positive, and obviously there are some question marks which kind of remain. And our panel today will largely kind of focus on trying to see whether this positive outlook is sustainable or is it shaky. So I'm very honored to have an esteemed panel today with us. We have with us Mr. Jugeshinder Singh, also known as Robbie, and he's a group CFO for Adani Group. Robbie, can you hear us?
Yes, I can hear you perfectly well.
And okay, there was some slight problem on the technology side, but yes, it's good that we can at least hear your loud and resonant voice, Robbie. Happy to be here. Robbie has been associated with the Adani Group in various capacities over the last 8 years, and he has over 16 years of global investment banking experience across Australia, New Zealand, North America, Europe, and Asia. And his experience includes aspects of mergers and acquisitions, strategy finance, and also particular focus in listed and unlisted infrastructure bonds. And prior to joining Adani, Robbie worked with Merrill Lynch, Macquarie, and the Commonwealth Bank of Australia. Also, he has done his Bachelor of Engineering from Punjab University, and he's completed his postgraduate diploma in Applied Finance from Bond University. A very warm welcome to you, Robbie. Then we have with us Mr. Jairam Sridharan. He's the MD at Piramal Capital and Housing. Jairam has over 20 years of experience, and he has served in range of domestic and international retail finance roles. Prior to his current role at Piramal Group, Jairam handled a variety of roles at Axis Bank, and he was earlier the president of retail lending and payments at Axis Bank. Jairam holds a bachelor's degree in chemical engineering from IIT Delhi, and he did his postgraduate diploma in management from IIM Kolkata, where he was awarded the Roll of Honor for academic excellence. In 2015, Mr. Sridharan was chosen by the Economic Times as a part of the 40 under 40 list of India's hottest business leaders. And in 2019, Institutional Investor magazine named Jairam as the best CFO in their All Asia executive team for banks based on the sell-side analyst scores. Very warm welcome, Jairam. Good to have you here.
Thank you, Sachin. Thanks for having me.
Great. And then we have with us Mr. S. Anantharaman. He is the Chief Risk Officer at the Bank of Baroda. And in his current role, Anand is managing the entire risk spectrum of the bank. He is member of the ALCO Investment Committee and the Credit Committee. And his earlier stint with HDFC Bank, he was the joint group head for large corporate credit. And prior to that, he was the group CFO and head of compliance at L&T Finance Limited. Anand is a chartered accountant and CFA with over 28 years of experience across credit markets and operational risk. A very warm welcome, Anantharaman. Can you hear us, sir?
Yeah, thank you. Thank you so much.
Okay, great. Thanks. Let me start this with my first question to Mr. Anantharaman. What Revati's presentation spoke about essentially on the positive credit outlook. Now, as we see it, one of the key reasons why the Indian corporates were relatively unscathed, by this whole COVID and other kind of challenges that we faced in the last 2 years or so, was largely because the corporates were, in a fairly deleveraged mode. The balance sheets were reasonably strong because not much of private capital investments have happened over many years, and because of which, even though a bit of hit happened in terms of reduced demand, reduced profitability, etc., but there was not much impact, and they kind of came out kind of reasonably safe. Now, you lead a large bank in terms of a risk. How do you see this going forward? Is it that because now there is a dilemma, now there is an expectation that the private sector investment should happen, the capacity utilizations are kind of now inching up, and therefore there is an expectation that the investment should happen. So at your perch, where you're sitting, how do you see it playing out in terms of investment versus protecting their profitability and their safe credit ratings?
Sure. See, first of all, I just wanted to share with you all that when the COVID hit us first, initially the corporate underwent a kind of confusion how to go about and all. At that point of time, they decided to borrow more stock, the borrowing, so that they have the cash in hand, and how the events turn around. Then accordingly, they created a kind of war chest at that point of time. Subsequently, they learned how to handle that. And the second wave, it was much better. Even if there is a third wave, which will be much better, because they have learned, the corporate are very much now accustomed how to manage this whole stuff. The second thing is that fortunately we had the vaccination drive happening in full force, and now the government has allowed for the third dose also. So with that, our ability to control that kind of events are very much within the reach. And giving in that context, if you really see that the capacity utilization of the corporate is improving, this was around 74.3% in December, as against 68.3% somewhere in September. So which means that if we reach between 78 to 80% level, there will be a real pickup in demand for credit. That's what we have broadly seen. So we expect that the demand for credit from corporate will increase. As of now, maximum investment is supported by the government. The government has come up with some beautiful policies, and they are equally supported by RBI. So the environment is quite good, despite a kind of the Ukraine Russia crisis. That's been taken care in a different manner. So we expect that things will improve. And we also have analyzed one broad thing, how interest coverage ratio has improved among the companies over last so many years, from 16 to the 9 month ended for December 22 when we analyzed. In fact, the companies with interest cover 3 and above, somewhere in March 16, it was around 57% of the universe. Now it is around 76%. So that itself is clearly shows that there is adequate deleveraging has happened. And with this capacity utilization kicking in and the various government policies which has been announced, we expect that that credit demand will pick up, and it's a good time to be in.
Great. Thank you. Thanks for those inputs. And I completely echo your points as well. Even as a rating agency, we have been kind of seeing quite a consistent decline in leverage. And you gave an interesting point in terms of how interest coverage ratio more than 3. The ratio is nearly 3/4 of the overall portfolio. So yeah, so interesting point. Let me bring in Robbie here. Robbie, very clearly there is infrastructure has been one of the growth drivers. Segments of it, roads, renewables, they have been doing well. The question that I have for you is that now in general we are seeing an expectation of the interest rates rising, and the capital, especially the international capital, maybe also becoming a little scarcer than before. Do you see that kind of having an impact on the growth story of India from the infrastructure sector perspective?
No, Sachin, thank you. I don't think that the rate environment per se, by in and of itself, changes the India's growth trajectory in relation to what we need to invest in infra. Largely because as the rate environment is rising, India's risk perception is dropping. So overall cost of capital is still within the range where it is hugely productive to be deployed to infrastructure. That's first point. Second is that with the aspirational nature of what is going on in the country, you see an alignment in politics where the economic policies of various political parties, be it TMC, be it Congress, be it BJP, converging, although their allocation and what they do in priority might be different, but the policy architecture is converging. So that provides a stability which was not prevalent even say 10 years ago or 20 years ago. So what you have is a consensus, which means that the ability to invest in Indian infra is rising. In relation to global funds flow for infra, that is not sensitive to rates. Equity flows could be sensitive to rates in terms of how equity moves around from portfolio point of view, but infra investors are investing for 20, 25 year, 30-year period. So once the risk perceptions are correct, then they are in they take a view which is right through the cycle, and that is the main aspect of it. That's where global capital becomes important, because the Indian our own domestic capital markets or our domestic banking market is not yet able to invest long term, and especially at fixed rates. When I say long term, I'm talking 15-year plus, and certainly 20-year plus in case of certain types of infrastructure. So the global infrastructure funds and investors are critical piece in the jigsaw for the infra investments. And as long as we can keep a lid on the overall cost of capital, then the movement within the capital structure, which is in this case rising rate environment, is not of a material concern.
Got it. Great. Thanks for that, Robbie. Jairam, let me kind of get you in here. One of the things which obviously there was a big concern if we were having this conversation two years back, one of the sectors which was generally everyone kind of agreed will get impacted was the NBFC. And there again, the segment which is, kind of the lower segment, the retail, the SME loans, the MFIs, those kind of segments. Now, while we do see there has been an increase in the credit cost for most of the people, but it is not something that is something to be really worried about. And that is the reason why, as Revati mentioned, the credit ratio for the NBFCs is also now kind of looking upwards. So the question that I have is that, have we really seen the pain? And is this that we will now, the happy days are here again in terms of, growth and, improving credit quality, etc.? Or do you see a fat tail of the credit cost still kind of remaining to be unwinded?
Yeah, no, it's a great question. Like, I think if you look at the lender segment overall today, I mean, so as borrowers don't really care whether they're borrowing from NBFCs or they're borrowing from banks, or like, it doesn't matter. Like, the all lender segments are similar. So it's important to actually look at it as a group. If you look at the NBFC plus banks as a whole, that group is probably better capitalized today than at pretty much any time in the last 50 years, right? And they probably as a group have much more provisions set aside than they have had at any time in the last 25 years, right? In general, it creates an environment where the entire sector, the lending sector, is very heavy on equity, has lots and lots of tier one capital to spare, right? And does not have much worries on the asset quality side, because so much set aside provisions are there. Like, so many people, every single bank and financial institution set aside massive amounts of money for COVID, right? COVID related asset quality issues. Nothing really happened, but nobody let those provisions go away, which means everybody is carrying extra provision buffer on their balance sheets, right? So whether there is room in lender balance sheets to actually go ahead and support a revival in demand in the market, the answer is heck yeah. There is a massive amount of room available. The bigger questions are the question that Robbie raised first and foremost, which is the lending sector big enough in India to actually support some of the needs that might be there for specialized sectors for projects? That's number one. And number two, are we going to see a reversal in the market in terms of the monetary policies of all regulators going in the opposite direction, and is that going to cause a blowback? And the demand side might turn out to be sort of more a mirage than we actually think right now, right? For the last 8 years, we have seen, or 9 years, we have seen significant monetary policy loosening by regulators all across the country, but not much action in the actual on the fiscal side, not much action on the real economy side. Now we are starting to see action on the real economy side, but unfortunately the monetary policies have gone so out of hand, and there is all this geopolitical risk that now the regulators have no choice but to tighten on monetary policy. So just when the economy is ready to take off, people have to tighten monetary policy. The question is, that sort of crack cocaine that the entire economy has been on across the globe for the last 8-10 years, does withdrawal of that cause enough physical symptoms for the patient to actually go through serious trouble or not? I don't think any one of us can claim to actually know the answer. We will actually see as the days goes on, but that's the big question in my mind. The question of, is the banking sector healthy, is the NBFC sector healthy, and can they support the growth? I think the answer is absolutely yes, but it might be a smaller piece of the puzzle.
Got it, Jairam. Interesting thing, you mentioned, I was referring to the corporate balance sheets being stronger and deleveraged. The point that you made is even the financial institutions, because of the provisions and otherwise, their balance sheets also look stronger. The question that I have is it that the institutional and the corporate balance sheets are getting stronger, but the retail balance sheets, that is where the borrowing is becoming more an order of the day, much more than, say, it used to be 10-20 years back. And now, with all these personal loans and, buy now, pay later, especially the young generation, do you see that? Because since you've kind of been in the industry for so long and you really track the retail thing very closely, is there any cause of concern that you see that this new generation who's maybe more keen to invest in stocks, more comfortable with leverage, even if it's for consumption, do you see that as a kind of a concern somewhere, as a potential risk building up?
Yeah. So short answer, Sachin, and I'll give a slightly longer answer as well. But the short answer is the concerns are overstated. I don't think there is that much to worry about. Let me give the longer answer. In these last 2 years, when the small consumer was going through hell pretty much, right? Small businesses were getting crushed. Lots of people were losing jobs. People were having to migrate and all that kind of stuff. There was this big fear that credit is going to blow up in retail, particularly unsecured credit is going to blow up. But what happened over these last 2 years? Basically, a fat lot of nothing, right? Nothing happened. Credit did not go up, or credit risk did not go up. There is a very small pocket in which credit risk did go up, but it was not material in the larger scheme of things, right? Very small tickets, personal loans did see an increase in risk, but they are a very small proportion of the overall credit to retail. It just didn't matter. It didn't move the needle, right? You did not see risk go up in overall personal loans business. You did not see risk go up in credit cards business. You did not see risk go up even in the MFI business, apart from that one period when we had to do a lot of restructuring, right? But for those, if you take those 3 or 4 months out, you didn't see anything, right? So fundamentally, risk in retail did not increase in this 2-year period. And now the take-home incomes of people, the business flow of small businesses, etc., has only improved, right? So the retail borrower is actually in better shape now. If you look at the overall leverage picture, as in the total amount of household debt taken on by a household, the number has actually not gone up in this last 2 years. In fact, it has gone down. Why? Because the single largest leverage is a home, and home buying has been so low in these last 2 years, right? So if you just calculate raw leverage numbers have come down for retail investors in these last 2 years. Of course, income has also come down a little bit, but and savings have come down, so that's an important aspect. But fundamentally, if you look at balance sheets and say, are balance sheets weaker or stronger than they were pre-pandemic? I'd say they are about the same. They got a lot weaker during the peak of the pandemic, but things are back, and what they lost savings, the households made up in not borrowing for 2 years, right? So essentially, we are at a place now where, in spite of all this noise about BNPL, etc., you look at retail credit, like how much is retail credit growing? It's still kind of very low double digits at best, and most times at most months in single digits, right? So it's not actually growing very much. What's growing is very short duration credit, which is continuing to get repaid. So what would essentially be called payment solutions, right, are what are growing, not lending or credit solutions.
Got it. Thanks, Jairam.
I just wanted to add one more point over there. Basically, this buy now, pay later, that concept is dying down. If you see, basically, this has come in Australia. And if you see few of the share prices of those companies like Playwright, SIP, Fatfish and all, no, it has come down more than 90-95% in that country. So in fact, even the market is also re-rating that concept. And as you rightly said, unsecured loan is one of the category which witnessed low amount of NPA level also. So that way, we don't see a major issue from that point.
Okay, got it. Let me ask another question to you, Mr. Anantharaman. Basically, this is in terms of, while when we look back, things look good, but the kind of commodity increases, price increases that we've seen, it's really, going really out of the range. So while yes, the commodity players, maybe the steel players, the non-ferrous, they are obviously going to, make good money, and they are kind of reporting good numbers. But the more, the manufacturing, the more, I would say, steady manufacturing, which are kind of consuming these commodities, they obviously are facing a lot of pressure. And on top of that, we have, situation in China where the lockdown is very severe. Obviously, the US is also, they will be kind of tapering down their balance sheets, and that may have its own impact. So do you see, for your, kind of credits, a major downside risk on the profitability per se. So while the balance sheets are good, but the P&L could be really not what all we were expecting in 22-23 vis-a-vis we were expecting it to be a fantastic year. Demand is good and everything is good, but now would these commodity prices really spoil the party?
See, I see it in a different manner. See, basically in this particular case, yes, definitely some of the prices are going up. Steel prices are going up. Base metal prices are going up. Even the crude oil prices is going up. So at some point of time, the ability of the passing on this increase in price at this point of time, the companies have not started to the fullest extent. We believe that if things are going in this manner, the companies will start passing on this increase. So accordingly, there will be an inflation pressure also, but it is not going to damage to that extent for large companies. So we have to broadly categorize then our analysis into three aspects: very large company, medium-sized companies, and MSME segment. So we believe that this will have much more impact on the MSME segment because they don't have that borrowing, they don't have the bargaining ability. So at this point of time, we believe that we have to be a bit cautious on that particular segment, especially when they are exposed to huge amount of commodity prices. Their dependency on those risk factors is much higher. Then we have to have a cautious rule. So over there we are a bit cautious, but that doesn't mean that we are not in that. We are actually growing in that business also, basically because we have got various government support schemes. That's a government support scheme is also getting extended, so that's playing a larger role. So to me it is only a temporary phenomena which may be there max for another 6 months or so. So after that this will get dusted out and things will be normal, because the kind of policies which each of the state government, central government are doing is phenomenal, and that's really conducive to the growth. So we expect with this capacity utilization coming in to touching around 75, crossing 75, the private sector investment will start. So overall, it will give a good impact, and I believe that the credit growth we should be in the range of 10 to 12% or 10 to 13% as against for that 8% growth in this current year. So everything is well placed. Maybe some amount of small aberration will happen in the 6 months period or so. Subsequently, things will turn out for good.
Got it. So reasonably, I would say neutral to positive outlook that you've shared with us. Robbie, next question to you. Your group really is in some ways kind of getting into the new age industry, so to say. Moving back into the value chains of renewable energy, also looking at hydrogen in a green hydrogen in a big way. How much, if I were to kind of play that at a national level, do you believe, because the numbers that I've been hearing about, reading about, is of a different order? Do you think that kind of could be an industry in which India really becomes a global player at some level?
I think in the longer term, we simply do not have a choice, because we can't continue under the developing geopolitical structures over the next 30 years, be reliant on our energy from imports only. So as our economy rises, we have to be able to protect our energy supply chain, and therefore to build a domestic energy platform becomes important. Now the good thing is that what's required for this domestic energy platform, one of those things, and another which is wind resources, we have in reasonable quantity and they are exploitable. So it stands natural that we extend our infrastructure footprint into this area, in which we look at decarbonization of the industrial landscape in India. That's one. The second is that as we get into this area, which is now clear world over, that very easily supply chains can be disrupted. So to build some integrity into the supply chain also becomes important. So some integration is required for supply chain security, because once we have that level of energy source, then we need to ensure also that the ecosystem that ensures the regular supply of that energy, India has some security of that supply chain. And as we become a bigger participant in the world trade, some of our investments will go into this area of providing energy security and supply chain security. And I think from our point of view, from Adani's point of view, our portfolio companies are well placed to play a very significant role in this. And obviously it depends on a lot depends on how we execute on these promises over the next 10 to 20 years. But India has a wonderful opportunity to be one of the pioneers in the new energy landscape.
Got it. Thanks, Robbie. One quick question, Robbie. We are hearing about this whole China lockdown being very, very severe, and Shanghai kind of coming under complete lockdown, etc. I mean, you have a good vantage view across industries. How bad is the situation there? I mean, if you can just give some perspective on that. How do you see? Do you see it worsening and therefore having a larger impact on the Indian supply chain? Because a lot of inputs do come, intermediaries do come from China. If you can share some thoughts there.
No, I think overall China is a very well managed economy and industrial infrastructure. So they have excellent protocols in place to deal with these kind of eventualities. It does short-term causes a short-term fluctuation and volatility, but I think in the medium term, this in of itself is a manageable situation for China, most certainly.
Okay, great. So I would now stop here and open the floor for question and answer from our audience. Mridul, can you just indicate how the questions need to be asked?
Sure. Thank you, Sachin. Dear participants, we can begin a Q&A session. In case of any questions, you're please requested to type in the panel. I repeat, we can begin a Q&A session. In case of any queries, you are please requested to type in your panel. Thank you.
While the questions get typed out, I just thought I will ask one question to Mr. Anantharaman. And this is on the Russia-Ukraine crisis, and that is where that's kind of a concern which everyone has now. It kind of, even though it's been now over nearly 40 days, 45 days ever since it started. Obviously, oil and gas is the more direct impact, and then there are a few other pockets where we talk of, maybe wheat, maybe sunflower oil, and a few other this thing. But Mr. Anantharaman, do you see it as something which is beyond this oil and gas? Oil and gas obviously has a economy-wide kind of an impact, and that's fine. I think that's still Indian analysts are kind of used to modeling that in some way or the other. But do you see that kind of an unknown or any perspective you would like to share with the audience, as to what could be the other impact, indirect impact that you may feel which will happen for the Indian economy here?
So basically, as you rightly said, the wheat and sunflower oil, that's where the price is expected to go up, but we will be able to manage that part. Basically, India import around 14 or 15% of the oil basket from that particular country. So we may have to diversify the resource, but to that extent, the price will go up. The one concern which I personally have is that on the neon gas, the neon gas maximum has been coming from Ukraine and that part of the world. So which is used for the semiconductor, which is very critical for a lot of industries. So we have to wait and watch how that pans out. That only time will tell. At this point of time, we are a bit cautious on that as a particular aspect. So that's the only thing which I wanted to share. Other than that, we are well placed to take care of that particular issue.
Okay. Got it. So, okay, first question I've got is, and that is, Robbie, I think you will be best suited for that. It says, how do you see credit movement in power sector now that we may not have the Atmanirbhar scheme to fund debtors?
See, power sector is a very large sector,
I think they're referring to thermal. I think that's maybe thermal is the something which kind of benefited the most. So if you can, respond in that context, please.
Yeah, thermal. See, thermal power, because it's our grid is dispatched on merit order. So what you have is as input costs are rising, naturally the dispatch percentages of thermal powers drop due to them shifting in the merit order, and as new renewable power comes, which is must dispatch, it gets dispatched first. But overall, as the demand profile changes, I think the consistent improvement has been towards the direction of on-time payments. There are stresses in the system. There are stresses particularly in certain states, certain discoms, but broadly, the payment architecture is improving, and the discoms are progressively on the improving path, albeit many of the discoms have a lot long to go.
Okay, got it. One question I have, this is for Mr. Anantharaman. It says, any specific sectors which look risky going forward? I know it's a very open-ended question, but if you can take a shot.
It's a very open. Yeah, basically, as you in the presentation itself, you all have said that the hospitality sector we have to be watchful, because it again depends on the global phenomena. At this point of time, if you check on any of the hotels and all, its occupancy is full at this point of time, and even the airlines occupancy is also improving. But unfortunately, in the airline sector, because the cost of fuel is increasing, the ability to pass on is not coming. So that is one sector we have to be a bit careful. The second one which we are watchful is that auto ancillary, because many of them are not able to have the full capacity utilization because of the non-availability of semiconductor, and that's getting delayed. That has to be a bit careful. The third one, which is gems and jewelry, because basically when these issues happens, the high end of the gems and jewelry section will get partly impacted. But fortunately, on the retail inventory jewelry side, things have improved because of the marriage season. Everything is happening as usual. Big fat weddings are happening again. So from that point, some of the companies are well placed, but especially on the diamond segment, especially on the large value diamond, we have to be careful. So and on the textile, there are some issues, but the Sri Lankan issue has really give us some room for export. However, there is competition from Vietnam. So we don't expect a major improvement over there, but still, things are okay. So to me, hospitality is one sector we have to be very, very watchful.
Okay, got it. Okay, one more question I have is, this is to Robbie. Your thoughts, even though we touched upon it a little while ago, your thoughts on hydrogen fuel cells and EV adoption in India. Would you like to add something here, Robbie? Basically, how quickly could there be EV adoption? Yeah,
I think there are two parts to mobility, which is broadly what this question is. The two-wheeler mobility, swappable batteries, a viable business case even today for India. It requires some technological support systems, but I think all of that India can surmount. Beyond that, in battery mobility, it's some time off, but overall, especially fuel cells, if in the hydrogen fuel cells, I think more than hydrogen fuel cells, there will be other forms of which hydrogen can be converted to, for example, e-methane, ammonia, etc. That would become viable before a very significant take-up of hydrogen fuel cells. It is a complicated technology, but in some of the industrials, it will work. For mobility, it's EV two-wheelers is the most likely fast adoption in India.
Got it. No, that's fine. I think in India, being a cost conscious thing, I think that is where and relatively faster adoption could be seen there. One question. Jairam, maybe if you can take a shot at this. It says how credit growth will be impacted from increase in US bond yields due to the increase in the inflationary environment. I think it's more relevant for corporate, but maybe if you can give your perspective, and then maybe I can come to Mr. Anantharaman.
Well, it will not probably. I think the whole global inflationary environment and what's happening in bond yields is a significant risk to growth. And in fact, if there is one big risk to growth that we can point out in the entire landscape, it's probably this, that what's happening in the inflationary space, whether it is crude driven or supply chain geopolitical risk driven, is causing both demand side issues, i.e. kind of people putting off capex that they might have been thinking about, etc. But also issues on credit supply side, which is based on Fed increasing rates and then maybe RBI increasing rates, and so basically both credit supply and credit demand will likely see negative effects. So there's a lot of stuff positive that's going on, which are positive impetus towards credit growth. But if you were to ask me the one big negative that looms large over everything, it is this sort of big inflationary pressure, which has lots and lots of dominoes that it can make fall. As we all know, as you ask every sort of macroeconomist, what is the number one thing that actually over long periods of time erodes economic growth and seems small but is the most powerful force in economics? It's inflation. Right, and it's rearing its ugly head all across the country, all across the world today. So there is very little positive to come out of it, to be honest.
Got it. There is a more specific question for Mr. Anantharaman. I will just read that out. What are your thoughts of asset quality in the MSME segments, especially in the rising commodity environment, giving a large proportion of MSME loans that have been restructured under the ECLGS scheme? So basically, impact of commodity price rise on the MSME segments, and since they were, they took benefit under the ECLGS scheme, maybe they were anyways a little exposed. So do you see that stress kind of building up and leading to default, etc.?
In the earlier remark, I very clearly said that the commodity price impact, we see it the sector-wise differently. Large sector will not get impacted. The mid sector will also be able to pass. But MSME segment is one segment where of their ability to really negotiate a deal much better than the large corporate is not very much there. So there will be definitely some impact. But to me, at this point of time, there is a full support from the government. So if things are not happening or shaping up the way in which it's not it should not be, definitely the government will pitch in, and to me, these are temporary phenomena. Even overall, broadly, if you analyze in the last 2 to 2.5 or 3 years, broadly, we have really taken care of all these things. So to me, even if a worst thing happen, it can be maximum of another 6 months or so when these events pan out. So we expect a full support from the government. So to me, there can be a slight increase in the NPA level, but it's not to cause of major concern. As Jairam rightly mentioned, most of the financial banks as well as NBFCs are sitting on a large amount of provisions. So their ability to handle those kind of issues are very much there. And we expect that continued support from the government, because government also wanted to encourage this MSME segment to a large extent. So there can be some small increase in the NPA level, but it's not going to cause a greater concern as far as the financial sector is concerned.
Got it. I think that's there are a couple more questions which are there, but I think we've kind of covered them in our earlier conversation. So with that, I think we are just finishing it on time. I think that's thing. I mean, the way I'm reading it, while Revati's presentation spoke about how the last 6 months have been good in terms of as reflected in the upgrade to downgrade ratio being at a decadal high. So obviously the last 6 months they were significantly large upgrade, reflecting the strength of the credit strength of the corporates. there were a few questions which kind of are being posed at us. We spoke about that, and the general broad consensus that I could see across a banker, an infrastructure player, and an NBFC CEO is that the things look like cautiously optimistic is how I would kind of say. While yes, no one is kind of undermining the risks which are kind of being portrayed, but in general the positives outweigh the negatives is how we are reading it. But yes, I think the times are tough for as I kind of keep joking to people, it's always now all analysts like us have been trained to do a YOY comparison, QOQ. Now you cannot do any YOY QOQ because in last year there would have been some second wave, third wave, some lockdown here, some lockdown there. So it's very difficult. I think we have to now, as analysts, start looking at more absolute things than mere relatives. Is how I'm looking at things. So with that, I'll hand it back over to Mridul. And again, thanks a lot to our panel. Very insightful points raised by all the three panelists. Thanks a lot for your time. Mridul, over to you for an official vote of thanks.
Yes, thank you, Sachin. Thank you, Revati. And thank you again to all the guest speakers for their insightful views. It was a privilege hosting you. And thank you to all participants for taking their time out and being a part of this CareEdge webinar. For any further queries, feedback, or suggestions, please respond in the feedback mail, which will be coming no sooner the webinar ends. Goodbye and thank you.
Thank you. Thanks, everyone.
Thank you. Bye.
Bye.
Thank you, everyone.